a good growth indicating a recovery, but below perhaps where we would like to be given how deep the recession was that we've been coming out of. And so overall, the global growth then is kind of not quite the midpoint, but near the midpoint of these two numbers at about 4.5%. And you can see that even within advanced economies, the experience is going to be comparatively similar, whereas in the emerging market economies group, there's quite a bit more diversity, with in particular emerging Asia having quite a bit stronger growth than Latin America and the Middle East predicted going forward. There are some downside risks, but relative to where we were in April 2010, which is this dashed line here, those downside risks have moderated quite a bit. There's risks on the upside too, but overall the downside risks seem to be a bit more weighing heavily. So what are the upside risks? Well, the upside risk is, of course, we've had quite strong activity in emerging markets, and so that could actually surprise on the upside if that continues. The other thing is in advanced economies was actually seeing quite strong corporate balance sheets, and so this may be indicative that these firms are going to be more willing to engage in investment going forward, which would again spur demand. On the downside, we have, of course, the sovereign and financial risks, in particular focused in Europe right now, and then, of course, oil supply concerns, which are going to be explored in a bit more detail later. So where does this mean all of the economies find themselves? Well, this is kind of real GDP in 2010 relative to kind of the trend prior to the financial crisis. Whoops. So this is giving us some sense of a kind of an output gap. And you can see that the world is still somewhat below kind of potential. The advanced economies are quite a bit below. They still got some gap there, whereas emerging market economies that gap is either closed or they've actually starting to move into positive output gap territory. In particular in Asia, Latin America, and Sub-Saharan Africa. This has actually been a bit of a bright spot here, is that Sub-Saharan Africa has actually done quite well recently. So what does this positive output gap potentially signify? It may signify some inflationary pressures. So in advanced economies, this is mostly due to commodities, but in emerging market economies, this these positive output gaps is indicative of very strong activity overall, and so that's potentially a source of stress. Interestingly, when you compare headline inflation and core inflation, you get a sense for that advanced and emerging market economies actually have very similar kind of patterns in their headline inflation, but where they differ is in core. And that's because food and fuel account for a much higher proportion of the consumption basket in emerging market economies than in advanced economies. And it's this core that we think is related to those kind of deeper inflationary pressures. So in many emerging markets, real policy rates are below where they were pre-crisis, even though output is now moving above pre-crisis trends and inflation pressures are broadening. And that we see here, where these rates are low by historic standards. In terms of fiscal, the public debt is actually going to be declining in these economies as they're starting to engage in pulling back from the stimulus that was deployed during the crisis. So credit, as I mentioned, may be a source of a strain going forward. So credit over the past 5 years, it's really booming. And you can see this across a variety of economies. And this chart compares the recent experience with a previous credit boom. And you can see that China, say, Brazil, Turkey, and the like, these are places where that credit growth is actually being quite strong. In the case of China, it's near the previous boom level. In the case of Brazil and Turkey, it's well in excess. In advanced economies, we think that policy rates can stay low because there's not as much sign of inflationary pressures. It's also the case a lot of these economies have very still have large output gaps, and unemployment is quite high. So we anticipate that these monetary policy can remain accommodative. The fiscal balance, you can see that even with some substantial consolidation going forward, that public debt is going to continue to rise for a while. So this is definitely a potential source of concern. The withdrawal of fiscal stimulus in 2011 is generally going to be limited relative to what had been expected previously, and we can see that here in the gap between this blue and the bar here. And for a lot of these economies, in order to stabilize GDP in the advanced economies, you can see that there's actually quite a bit more adjustment that's going to be required as opposed to what we're actually expecting them to undertake over the next 5 years. The financial sector, the repair of this has got to be accelerated in advanced economies, as we can see in particular in Europe, where we have here the kind of euro periphery kind of spread versus kind of core Europe spread. And core Europe is generally that government yield spread has been comparatively stable, whereas of course for periphery it's really gone up quite a bit. This is this global demand rebalancing. This is the persistent current account deficit and surplus economies. These imbalances that we see here narrowed somewhat with the crisis, but they've actually kind of started to expand a bit again. Most of this narrowing has been driven by negative structural forces, meaning that output fell so much, and in many deficit economies, this translated into a larger fall in imports than in exports, which meant on net, their current accounts kind of improved. And then when we look at a variety of these economies, these excessive external surpluses, excessive external deficits, we can see that we're not seeing much difference from what we had predicted in October. But in order for these kind of imbalances to kind of rectify, we need to see more kind of action on this. Domestic demand in emerging market Asia is not projected to accelerate much, but the large buildup in reserves, this is leading to some inflationary pressures, also leading to potentially excessive credit growth, and also this is evidenced in the kind of resisting of real exchange rate appreciation. That is we think part of a natural component of the rebalancing that's got to occur. And in emerging markets, you can actually see that emerging markets that have had excessive external deficits have actually appreciated more than those with excessive external surpluses, which is kind of the wrong direction, if you will. So that kind of concludes for the outlook component, and now I'm going to pass over to Jung-Sik, and he's going to cover a bit on the commodity outlook.